Wall Street isn't just a physical location in lower Manhattan, it is a cold, calculated machine that operates 24 hours a day with one single goal: to transfer wealth from the uneducated to the institutional elite. Every single year, millions of Americans pour their hard-earned savings into the market, hoping for a better future. Yet, the statistics remain hauntingly consistent. 90% of these retail investors will fail and lose it all. But why? Is the game rigged? Or are we simply walking into the same hidden traps that have been catching investors for over a century? To survive, you have to understand the mistakes that the 90% are making right now. Success in the market isn't about having the best luck or the fastest internet. It's about avoiding the psychological landmines that are buried under every green and red candle you see on your screen. Welcome to Common Blunders. We aren't here to sell you a dream. We are here to show you the reality. Today, we're breaking down the 5 hidden mistakes that are standing between you and the wealth you deserve.
Mistake number 1, the lotto ticket mentality. In America, we are obsessed with a big score. We want the next Nvidia, the next Bitcoin, or the next meme stock that's going to turn $1,000 into $1 million. This mindset turns the world's greatest wealth-building machine into a high-stakes casino. When you trade for excitement rather than for value, you aren't investing, you're gambling with your family's future. This is fueled by FOMO, the fear of missing out. You see your neighbor or a coworker making money on a junk stock, and your brain's survival instinct screams at you to get in before the opportunity vanishes. But here is the brutal truth. By the time you hear about a sure thing on social media, the professionals have already moved in, pumped the price, and are waiting for you to buy so they can sell at a profit. You aren't getting in early. You are providing the exit liquidity for the banks. You are the one paying for their luxury vacations while your own retirement fund slowly bleeds out into the red.
Mistake number 2, outsourcing your thinking. We live in a world of signal groups and financial gurus who claim to have the secret sauce. But following a tip without doing your own work is financial suicide. When you buy a stock because someone else told you to, you have zero conviction. The moment the price drops, and it will, you won't know whether to hold, sell, or buy more because you never understood the why. Without research, you are a ship without a rudder in a Category 5 hurricane. Real research is painful, it's boring, and it takes hours of reading dry financial statements. That's exactly why most people refuse to do it. If you aren't willing to spend 5 hours researching a company, you have no business putting $5,000 into its stock. The market is an open book exam, but most people are trying to cheat off their neighbor. Stop looking for leaders to follow. Start looking at cash flows, debt-to-equity ratios, and competitive moats. The market doesn't pay you for your hope. It only pays you for your superior perspective and data. Mistake number 3, the silent killer, leverage. This is the ultimate hidden mistake. In a low-interest world, the temptation to use margin or borrowed money to multiply your gains is almost impossible to resist. Leverage feels like a superpower during a bull market. It makes you feel like a genius. But leverage is a double-edged sword that is specifically designed to cut the retail investor's throat during the slightest dip. When you use margin, you lose your most powerful weapon, time. You no longer have the luxury of waiting for the market to recover. You are on a ticking clock, and the broker owns the battery. A margin call is a cold, automated notification that doesn't care about your long-term thesis. It will liquidate your entire portfolio at the absolute bottom of a crash, leaving you with nothing but realized losses. Most of the 90% who fail would still be in the game today if they had simply used their own cash. Leverage is for the professionals who can manage the risk. For the retail investor, it is a trapdoor to zero. Mistake number 4, the biological glitch. Our brains were evolved for survival on the savannah, where running from a lion was a good thing. But in the stock market, that same flight instinct is your worst enemy. Loss aversion is a documented psychological phenomenon. The pain of losing $1 is twice as intense as the joy of gaining one. This is why you hold on to your losers for too long and sell your winners too early. When you see red on your screen, your brain enters panic mode. You sell at the bottom just to make the emotional pain stop. And then, like clockwork, the market rebounds the moment your position is closed. Then comes revenge trading. You try to get back at the market to recover your losses quickly. This is the gambler's spiral. You take bigger risks with less logic, and you end up destroying what's left of your capital. The top 10% of investors have learned to become cold and robotic. They have mastered their own biology. They don't trade what they feel, they trade what they see. They embrace the red as an opportunity, not a threat. Mistake number 5, the all-in fallacy. We've been told that fortune favors the bold, but in investing, fortune favors the diversified. Putting your entire net worth into one sector is a disaster waiting to happen. You might get lucky once or twice, but the market is a game of probability over a lifetime. If you have a single point of failure in your portfolio, it's only a matter of time before that point breaks under pressure. True wealth is built on the foundation of compounding, the 8th wonder of the world. But compounding only works if you stay in the game for decades. You can't compound if you've been wiped out by a single bad bet. While the 90% are chasing 100% returns every week, the successful 10% are happy with 10 to 15% a year, every year, without fail. They understand that the slow way is actually the fastest way to get rich. Financial freedom isn't about hitting a home run. It's about avoiding the strikeouts. It's about being the person who is still standing when the dust settles and the market cycle starts all over again. Take a long, hard look at your current strategy. Are you making these hidden mistakes? Are you behaving like the crowd that loses, or are you preparing to join the elite group that consistently wins? Start today by building a written plan. Define your entry, your exit, and your risk tolerance before you ever click buy. If you don't have a plan, you are simply a victim waiting for a market crash to happen. Here at Common Blunders, our goal is to give you the tools to survive the hidden traps of the financial world. We break down the psychology so you can build a portfolio you've always wanted. The market is a transfer mechanism. It moves money from the impatient, the emotional, and the uneducated to the patient and the disciplined. It's time for you to get on the right side of that equation. Subscribe to Common Blunders for your weekly reality check. Hit the notification bell so you never miss a deep dive. Stop being a statistic. Start being an investor. We'll see you in the next one.